It's a pleasure to have you today join us on this very interesting discussion around 2026 global economic transformations and opportunities. So we're doing this as part of our annual Global Economic Outlook briefing. And I think the outlook for 2026 becomes particularly significant considering a lot of the trade upheavals we've been seeing through 2025 under the Trump administration. So as businesses enter the next year of strategic planning for 2026, we've designed this particular Global Economic Outlook session to answer some of your top of mind questions that you might have at this particular juncture in the sense of, are you expecting to see a are we expecting to see a major dip or a rise in global growth in 2026? With all the news that we're reading about trade policy changes and even new trade deals, which are some of the countries and markets companies should be prioritizing in 2026 for geographic expansion. And to provide some of these expert insights and more, I'd like to introduce you to the rest of my team. If we could move to the next slide very quickly. Starting with Rituparna Majumdar. Ritu is an industry principal with our economic analytics division. She's responsible for a lot of the data forecasts that you see being churned out today. You also have Nikita Talnika, who's a senior research analyst with the economic analytics practice at Frost and Sullivan. So very quickly, moving over to the agenda of what you can expect over the next 30 minutes. We will start with 2025 highlights and outcomes, very quickly summarizing what have we seen in terms of GDP growth figures, where has inflation leveled out at, and the like. Before delving into our 2026 global GDP forecasts and visioning scenarios. We feel that when it comes to visioning scenarios, this is a particularly important element. So you're not working with just one track forecasts, but you do have those plus or minus base case, optimistic and pessimistic scenarios, which are crucial in today's volatile environment. We're then segueing into top predictions, very importantly, also touching upon country resilience frontrunners based on a proprietary toolkit of ours. And we'll then conclude with some of the growth opportunities we're seeing across regions and key growth expectations, as well as business response strategies. So before we begin our session in detail, we'd like to take a quick audience pulse of where you expect the global economy to be headed in 2026. So we do have a poll question for you here today in terms of what are your global GDP growth expectations for 2026. So I'm just going to hand it over to Julieta here for a minute to launch the poll.
Thank you. So please feel free to submit your vote. What are your global GDP growth expectations for 2026? We have stable growth, growth slowdown, global recession, growth acceleration. We'll leave this poll open for a minute so that you can submit your vote, and then we will discuss it with the panel members. Thank you. So we can see we have a 67% of voters that voted for growth slowdown, followed by a tie between global recession and growth acceleration.
Thanks for those for the responses, audience and Julieta. So I think it's not very surprising, the results, particularly in the global environment that we're in and all the news we see coming in every day about trade policy U-turns and the like. I'd like to invite Ritu, particularly at this juncture, to comment on the poll results and also Frost and Sullivan's view on the global economy.
Sure. Absolutely. Thank you so much, Neha. And thank you everyone for joining our today's webinar. Well, yes, absolutely. I think that resonates quite well with our assessment. At Frost and Sullivan, we are also projecting a mild global growth slowdown from what we are looking at in 2025 of 3.1% in terms of the global GDP growth to around 2.9% in 2026. And that's of course a mild global growth slowdown. And this is mainly going to be because the trade momentum that took a spike in the past few months is going to soften in the early half of next year. And tariff effects will also continue to linger for some more time. But overall, there is no risk of recession or growth sliding to, let's say, historic lows or anything like that we're seeing at the moment, you know. And in fact, I have a few slides to take our audience through, as we talk about the global GDP, the 2026 global economic outlooks. I would specifically like to focus on some of the nuances around global GDP growth forecast. We also have drawn out, as Neha was mentioning, we have a few visioning scenarios around that. And I would also like to highlight some of the major economic themes that are shaping, particularly in 2026. And through these insights, we would like to answer why we think it's going to be a mild slowdown and not a recession for the next year. And before that, let's take a quick recap of the key highlights from the 2025 global economy. We'll move to the next slide. Yeah. So what we are seeing on this slide at the moment are 2 points in time. Frost & Sullivan's January 2025 forecast and our December 2025 estimate. The reason why we have kept 2 data points here is to help our audience understand what changed, why it changed, and how different key parameters evolved over time. So, for example, when we look at the global GDP growth for 2025, what's interesting is that our January forecast and December estimate are identical at 3.1%. So what happened was when we look at the year that panned out in the first half of the year, global GDP growth held up better than expected. There was a lot of trade front loading happened in the first half of the year, specifically in the months of March and April, just after the reciprocal tariffs were announced. And businesses rushed to import goods before the tariff hikes set in. However, as the year progressed, tariff-related pressures started to set in, particularly coming in from US-China tariff wars or the US-India tariff escalations and things like that. That sort of prevented the momentum in the second half of the year. But net an eventful 2025, a lot of volatilities, but still global growth is expected to be higher than 3%. So that's a good news. And that also sort of sets the tone for why we expect only a mild moderation in 2026. Looking at some of the other key parameters for this year, global inflation continues its downward glide from our 4.4% of expectation to about 4.2% in the final reading, all thanks to high interest rates in early 2025, which helped to sort of cool the demand. Then obviously we also saw stabilizing food prices, energy prices over the past few months. When we look at the oil price trajectory, prices for the Brent crude oil, again, a downward glide as well from what we expected earlier in the year. And that's basically due to higher than expected non-OPEC supply, particularly coming in from the US, Brazil, and Guyana. And we also see an unwinding of OPEC plus production cuts in the second half of the year. So, of course, a lot of supply coming into the global market, which are sort of pulling prices down. Now, on the labor market side, when we look at the unemployment rate, which is at around 4.7%, final 2025 numbers sort of in the same range as our expectation back in Jan. A few factors are playing out when we look at the labor market, a strong job creation in some of the countries like the US and the Gulf, but slow hiring when we look at Europe and China. And also importantly, automation, right? AI-driven automation that continues to replace some roles. Of course, this keeps the job churn high and unemployment sticky. When we look at the currency, of course, dollar is obviously there is continued trade friction that is curbing dollar's safe haven appeal, and it actually contributes to a gradual depreciation of the dollar to some bit. So basically, overall, when we look at the world economy for this year 2025, it turned out to be a year of volatility. But the good news is that global GDP growth is still quite solid. Inflation has eased, and there is a labor market which is fairly resilient. So, with that in mind, let's move to our next slide, into the global outlook for 2026, where I will walk our audience through our scenario-based forecasts, and I'll discuss what they mean for our businesses today. So in this particular, this is very interesting and form the core discussion of the global economy and our discussion basically. So in this particular slide, we have displayed the GDP growth projections on the right-hand side of the slide for the global economy, for advanced economy, and for the emerging markets. And on the left, we have drawn out 3 specific visioning scenarios, keeping in mind the current economic volatility and how different aspects of the global economy are panning out. So we have a base case, a baseline scenario based on what's most probable. We also have 2 other plus or minus scenarios. One is an optimistic scenario and one pessimistic scenario. But why do we talk about scenarios? Because, of course, the way the global economy is panning out is extremely volatile. And scenarios, they are not just predictions and numbers, they are planning tools. They help businesses as well as policymakers stress test strategies against differing economic conditions. For example, if there is new trade deals coming in, that's an optimistic call for businesses to sort of accelerate factory builds or sort of accelerate capex. Or for example, if inflation is sticky or inflation is rising, then that might lure businesses to reorient sourcing, so on and so forth. So here in this slide, let's begin with the baseline scenario. So global growth under the base case scenario expected to be moderating from 3.1 to 2.9. So that's a mild global growth slowdown. We're also expecting mild moderation across both the advanced and emerging markets. When we look at some of the key elements of the global growth, tariff pressures will continue to linger, but they are contained, through selective trade deals. Obviously, we know that USMCA is up for renewal, that review of which is scheduled for July 2026. There is also a possible US-India agreement that is on the cards. And on that front, the first tranche of the trade deal is getting finalized in November itself. So we have all the reasons to expect a full-blown trade deal coming in next year. Then when we look at the oil prices, that may continue to stay below $65 per barrel in the first couple of months and maybe in the first quarter due to oversupply, but we expect it to rebound in the second half as we expect OPEC to resume output cuts. For businesses, this baseline scenario means planning for moderate demand growth, especially coming in from the emerging markets. Companies should prioritize cost efficiency and regional diversification. But then when we look at the optimistic scenario, obviously we are looking at a global GDP growth that is expected to outpace 2025 levels. And in terms of the drivers, obviously we are expecting greater, higher, stronger trade rebound, successful US trade deals, not only with regards to the USMCA or India, but also coming from other countries like Japan, or it could be European Union. And for businesses, this is definitely an opportune environment. Companies can lean into expansion strategies, invest in capacity building, and try to capture demand in emerging markets. But then the pessimistic scenario, on the other hand, of course, under that scenario, global GDP could fall to 2.5%, the lowest since the COVID times. And some of the factors that could trigger such a scenario would be, renewed geopolitical tension. For example, either coming in from the Iran-Israel tension or tariff escalation of key countries with the US that would basically reignite supply disruption. Under such a situation, even though seems to be the least likely at the moment. But still, under such a situation, businesses should opt for I would say, opt for a defensive playbook. They should focus on risk management and focus on local sourcing as much as possible. So we move to the next slide where I am going to be highlighting some of the key transformations from the global economy side of things and some of the key economic trends for 2026. So, of course, we start off with the global GDP growth, which we've just discussed, which is as per our baseline expectations coming down from 3.1 to 2.9. And this particular slowdown ties directly into pricing trends. So, let's also look at what's happening with inflation. So, on inflation, we expect price pressures to ease next year, mainly because wage growth is cooling. And also, when we look at oil prices that are also moving lower than average. And with inflation stabilizing, the next big question is what happens to trade flows? What happens to supply chain? Trade growth is set to slow in 2026 because obviously when we look at 2025, we saw a lot of trade front loading happen in this year. That is going to fade when we enter 2026. We also expect lagged effects from higher tariffs, and we also expect some level of uncertainty around trade policy, around the USMCA review renewal, etc., to linger, and that will also sort of limit trade growth next year. Now let's touch unemployment quickly. So on the job side, things stay steady. Unemployment rate holds at around 4.7% in both 2025 as well as in 2026. And behind the scenes, obviously, when we look at some of the key elements, we see AI-driven investment, and that is creating a strong demand for high-skilled talent. And obviously, some entry-level roles continue to be automated. So yeah, so some layoffs will continue, and some new job creation will also continue to happen. So net headline number looks flat, but there is this job mix that will continue to happen. That will change basically. So the job mix is changing basically. So now we look at the energy markets. So energy markets, of course, play a role here, especially for inflation, for manufacturing costs, for raw materials and the feedstock. So let's look at oil. So oil, we're expecting prices to soften from around $70 average per barrel for 2025 to about $63 per barrel for 2026. And oil oversupply, which is happening now in the oil market, will continue to remain in early 2026. That sort of pulls prices into the lows. And then we expect OPEC plus cuts to again come back, which would sort of push prices back up later in the year. So overall, oil becomes a mild disinflationary force in 2026. And with that quick summary of what's going to happen for next year, I'll hand it over to my colleague Nikita Talnikar, who will take us into some of the micro level implications. Over to you, Nikita.
Thanks a lot, Ritu, for that detailed scenario-wise insight, shedding light on some of the key themes we should be expecting for the upcoming year. So over the next few slides, we'll explore our growth forecast at the country level, which countries are standing out as investment magnets despite of so much uncertainty at in the global arena, and then also some of the region-wise key growth drivers for 2026. So on the next slide, we are showcasing key economies, both in the advanced and the emerging market groups, and what we expect in terms of their growth forecast for 26. So let's start off with the US. US growth edges up just slightly, to 1.7% in 26 compared to an estimated 1.6% this year. This is mainly being driven by steady fiscal stimuli and the positive developments that we are seeing in terms of country-wise trade deals being hit. AI capex has been a growth driver throughout this year and will continue to remain an upside for the US next year as well. The tax reforms are likely to help sustain investment as well as spending momentum. However, just to mention a point of caution, given the tariff uncertainties and the risks which are emerging out of it, especially inflation, the Federal Reserve likely to be on the side of caution in terms of the rate cuts. So it remains to be seen on what trajectory the Federal Reserve will take. But in net, we do expect US rate cuts. Only the pace remains to be seen. Germany is showing a modest recovery. This is mainly coming from the fiscal support. Infrastructure and defense spending is expected to move up, which will provide a domestic multiplier effect, despite of a broader slowdown, which we are seeing in the overall European Union in 2026. Moving on to the Middle East, Saudi Arabia growth will soften from just slightly from around 4% to 3.8%. The domestic demand, which has been resilient, then value add from the non-oil sectors, private sector resilience, and the payoff from the economic diversification efforts of the government are going to provide a timely growth upside for the kingdom. So the expected oil price upswing in second half of 2026 should definitely help offset some of the pressures which we will see due to the lower forecasted oil prices for early 2026. India continues to remain a global growth catalyst. GDP, we expect it to rise from 6.6% to 6.7% next year. GST reforms, then some of the main individual income tax reforms, then infrastructure-led capex are going to ensure that construction, logistics, consumer industries remain in high growth arena. And these points are reinforcing India's resilience amidst a globally uncertain growth backdrop. China, lastly, China's growth, we expect it to slow from a 4.7% this year to a 4.1% next year. It's mainly reflective of the structural issues which the country is facing, and also the tariff headwinds, being US one of the key exporting markets. But on the other hand, high-tech investments, AI investments, the country's continued fiscal support, and an increasing scope for a full-fledged trade deal amidst the ongoing negotiations beyond 2026 will definitely provide some tailwinds for overall growth for China next year. So moving on to the next slide. Until now, we have been discussing about how global growth will moderate from a 3.1% this year to around a 2.9% in 2026. We have seen how advanced economies are cushioned by fiscal support, how emerging markets are seeing resilient demand. But we truly believe that the story doesn't end there. There's a much larger picture. Despite all these tariff disruptions, trade uncertainties, geopolitical flare-ups, as Neha mentioned, our firm's proprietary tool, the Frost Radar for Economic Development in 2025, took this entire focus on how countries are resilient in this uneven global backdrop. And what we saw was that during this comprehensive benchmarking exercise, where we assessed 40 key economies based on their economic and trade resilience, future growth and innovation potential, we saw that these 10 countries, which you see on the left-hand side, the top 10 rankers, were faring extremely well on the economic resilience as well as the growth resilience, as well as the innovation resilience metrics. So the UAE, for instance, they rank number 1, mainly driven by their diversified economy that has really ensured that they remain protected from some of the oil price shocks. Their focus on high value add sectors, AI, digital, as well as infrastructure transformation, and also their ability to attract skilled labor positions them as a safe haven for global investors. Saudi Arabia ranked second. Their logistics transformation has been really fast-paced. Non-oil sector growth has been really great over the past couple of years, as the diversification efforts have been paying off. They don't face any reciprocal tariffs, only the 10% baseline from the US. So all of this put together, that makes the Middle Eastern nation, a great hub, even if oil markets fluctuate in the near term. India, as has been the story for almost the past 2 to 3 years now, continues to remain a global growth catalyst beyond its forecast for 26, which is 6.7%. CapEx-led growth, robust domestic demand, cost-competitive production base make it a magnet for investments, especially in an era which is being defined by supply chain restructuring, reshoring, nearshoring, and so on. And then Singapore and Switzerland have also shown up to be prominent players in terms of economic resilience, their high-tech leadership, the trade deals, as well as low reciprocal, or rather no reciprocal tariffs in case of Singapore, really position them as the safe havens for investments, foreign investors especially. So while global growth slows, uncertainties continue to persist, these frontrunners are really demonstrating that strategic diversification and domestic resilience, which can create a lot of investment appeal for our global clients. So for businesses, this means prioritizing your expansion expectations and plans rather into these high resilience economies for future proofing your growth trajectories. Moving on to the next slide, I would just like to shed some light on the region-wise growth opportunities. So in terms of, I'll start on the left from North America and move on towards Asia Pacific as I go. So North America, tax reforms in the US, the recent cuts under the OBBBA are going to be rather critical to provide private sector as well as domestic spending thrust. AI and digital capex continues to remain strong in the US. So that means the region is positioned for both demand and productivity growth. Tax cuts and incentives are hence driving household spending and supporting consumption upside. Then Latin America, these nations are seen to be deploying fiscal support, which is going to cushion, the demand. And inflation is also on a downward trajectory in the region. So that is a good upside coming in. And some of these nations, such as Mexico, Brazil, Chile, they are really rolling out manufacturing and nearshoring incentives. So that makes them a good investment. That makes them a good, location for foreign investments. Brazil, they launched a new industrial policy in 2024. What was interesting was that they are deploying one of the largest productive transformation financing worth almost $50 billion. That too injected over just 3 periods, 3 years, 2024 to 2026. So this will have positive spillover effects for technology acquisition, R&D expansion, and also the MSME growth within the country. Then moving on to a critical region, Europe. Defense spending has been a critical theme for growth in this particular region, and it will continue to remain so in 2026 as well. European Union's defense spending, on the top of my head, the numbers are that it will surpass $440 billion this year and will continue to remain on an upward trajectory through the next year as well. So, for instance, the European Commission has allocated roughly $5 billion for defense and allied sectors in the 2026 budget, which also includes, interestingly, a fund of funds worth $1.2 billion, which will be on defense-related project funding only in the first half of 2026. So a lot of defense capex has been going on. Similarly, Germany, as I already mentioned, fiscal support has been massive. They are investing $40 billion purely for transport and infrastructure next year. Around $6 billion have been allocated for social housing construction. So all of this put together are going to drive multiplier effects for construction, machinery and equipment, metals, etc. Middle East, we have already spoken a bit about oil prices. So firstly, the oil price outlook for the second half of the next year will determine how much fiscal space all of these nations have. So that increased fiscal space in H2 is what will really drive non-oil public capex. So that will bode well for the overall region. UAE, I would like to put a highlight. They have earmarked their highest ever budget for next year, which is a 29% year-on-year jump compared to 2025. So their domestic demand, pro-investment policies, and a really robust fiscal structure is going to ensure good growth for the United Arab Emirates. And then lastly, I'll move to Asia Pacific. India, I'll repeat once again, continues to remain a resilient growth hotspot. They have earmarked roughly $140 billion of capex only for the FY 2026 budget. So capex push is really driving a lot of infrastructure-led demand, be it for construction, logistics, equipment, and will have a lot of multiplier effects in 26. And across developed Asia and China, what we have seen is some of the high-tech sectors such as AI, semiconductors, electronics, their investment cycles have been pretty strong in 25, likely to remain upbeat in 26 as well. So this will continue to provide opportunities for manufacturing and as well as strengthening their domestic supply chains. So a higher private capex and allied productivity gains are expected because of these investments in high-tech sectors. So this all about the growth opportunities, and now I will hand it over to Neha to shed some light on expectations and the final story for 2026. Over to you, Neha.
Thank you, Nikita. Thank you, Ritu. So to summarize today's briefing, if we can move to the next slide, you will see here a bird's eye view of some of the key restraints, risks, and opportunities that you should be factoring into your strategic planning exercises for 2026. And on the right, you will also see some key agile business response strategies. So for example, like we've mentioned, there will be a level of mild global slowdown in terms of GDP, as well as some global trade slowdown that you should expect for 2026. What this might mean is that some of the traditional markets that you export into, let's say in a US or a China, you can potentially see slightly weaker demand. So organizations should be continuing to diversify their exports into other markets. I'd say that supply chain and export diversification continues to remain the name of the game, both on the export and the production side of things. And we'd encourage you to particularly look at some of the country resilience frontrunners that we've highlighted, whether it's in India or the like. And it's particularly important to invest into not just one of these newer geographies, but to ensure that investments are spread across the geographies, because any particular geography could become susceptible to newer trade war realities and the like. In terms of opportunities that we see, definitely a lot of AI-related spending that we're seeing in 2026. Also with the slightly lower interest rate cuts that we're seeing globally, borrowing costs are going to start to decline. And like Nikita had mentioned, we're also going to see tax-related deals boost consumption as well. So a combination of tax reforms and lower borrowing costs will sort of speed up consumption, whether we're talking about higher demands for, say, auto loans, or even higher demands for products such as large-scale electronic items that need to be financed through loans. And we do see that as this demand starts to uptick, there is opportunity to produce locally, especially to cater to this demand. Because when you look at the global landscape of things, there could be supply chain chokeholds that emerge because of the trade wars. So as your demand spikes, whether you're talking about cars, whether you're talking about large-scale electronics items, it does make sense to start producing a lot more of these in local numbers to cater to the demand. So that brings us to the end of the presentation. So at the start, we had put a very pertinent question about, is the global economy moving towards renewed growth or a downward spiral? I do believe we've answered that. Our consensus forecast is that it's going to be somewhere a little in between. It's not going to be renewed growth, but neither a global recession. We do see a mild slowdown happening from about 3.1% in 2025 to 2.9% in 2026. That being said, I would encourage you to watch out for signs of resilience in the global economy, because if anything, the growth story of over the past 3 to 4 years has been of resilience, has been of the global economy generally outperforming expectations. Even if we're talking about 2025, in a year where we had a lot of tariff wars, which you could call it, you saw the front loading of imports, which sort of rescued the global economy and continue to maintain the growth momentum. So I wouldn't be surprised if we do see some of those surprising upsides come about in 2026 as well, and you do eventually start to see an uptick in the global economy. Okay, touching upon growth workshops there just for a little bit, if we could move over to the next slide. We do have a slightly more macro to micro proposition around what we've just discussed today in terms of the global economic outlook, but a workshop more importantly centered about what that means for your organization. So it's a half-day workshop that we typically do with executive leadership, focusing around aspects such as risk heat mapping, scenario forecasts, and the like. And most importantly, delving into what the evolving global economy means for your organization or your business in particular, because that, of course, differs based on your geography of operation, the industry that you're operating in, your supply chain relations, and the like. So you can see some of the benefits that we've outlined here. So some of the typical answers that you will get coming out of this workshop is sort of, if we're expecting a mild global slowdown, which geographies should you as an organization be targeting for expansion? Or for example, right now we're seeing a couple of US bilateral trade deals being signed. So how should your company reroute or optimize your trade and supply chains to leverage or make best of the lower tariff levels? So you do have my contact details here on the screen. Please feel free to get in touch, and I'd be happy to set up a dialogue or a discussion to discuss how the growth workshop around the 2026 global economy can benefit your organization. You have my email details on the slide. Feel free to reach out to me. So I know we've talked a lot about trade deals. So rightly so, we do have a question around trade deal expectations. So the first one is, what is Frost & Sullivan's expectation when it comes to the USMCA renewal for next year? And how do you see that impacting business decisions? Nitu, over to you.
I will take that, yeah. I will take that, yeah. That's actually a good question, because USMCA review is definitely going to be an important event in 2026, because it sort of remains the foundation of North America's economic strength. So our view is that the USMCA will likely to be renewed. It is scheduled for July 2026, but this might not be just a routine renewal. And this might not roll forward for another 16 years as we had originally viewed. So there could be delay, there could be disagreement, especially on issues such as tariffs, on rules of origin, on non-trade issues like fentanyl. So we might see a potential introduction of, let's say, annual review mechanisms. And in a more severe scenario, one country could withdraw. That could, if that happens, that will lead to individual bilateral deals over the medium term. So these are some of the possibilities. But our baseline viewpoint is that the agreement continues, but under tight conditions that we've had so far. And if USMCA weakens, several sectors will get impacted, especially when we look at the automotive industry, because production is spread across all three countries. Then there is energy cooperation that is also so much linked, right? Then food prices, that is also extremely linked. So what's happening is we are advising our clients is to build contingency plans for supply chains that sort of touch North America. And we're also hearing a lot of our clients that are trying to avoid large investments until there is more clarity. So yeah, I mean, I think USMCA is definitely one element that our businesses should definitely keep a watch out for.
Very interesting perspective, Ritu, especially as I know a lot of companies in that region are going to start planning for the year ahead. Another question that we have, can you tell us a little bit more about Mexico's growth trajectory for 2026, especially considering the tariff situation?
I'd like to take that if that's okay.
Yes, sure.
So Mexico is actually a mix of two factors. If you look at the numbers, they are moving up in comparison to 2025. And where that is coming from is in 2025, the US tariff headwinds actually ended up resulting in a sizable slowdown. But on the other hand, what is happening is domestically, inflation is coming within the central bank's target range. So we see a scope for interest rate cuts happening next year. And then, as Ritu rightly mentioned, the USMCA renewal, while it does put a lot of pressure, like a lot of uncertainties in place, it also provides some level of, upside to investors and even growth expectations that if the renewal goes smoothly, then that means, exports are going to normalize to the US. So that is somewhat being, keyed in to the growth forecast for 2025. And we see Mexico growing at a 1.3% roughly next year compared to a 0.9% for 2025.
Thanks for your perspective, Nikita. I know we're pretty much on the hour and that we're also nearing the end of our Q&A.